everyone. Welcome to the Trading Zone. Thanks for hanging out with us. I'm Joe T. Gay, Equity Armor Investments, and with me is Brian Stutland.
Also portfolio manager at Equity Armor Investments.
How are you doing, Brian?
Great. Yeah, it's a good Monday. We have an exciting week on tap for the markets. Really a lot to talk about. But, Joe, I'm starting to see some craziness happen, which could lead to some volatility later in this year when we're looking at really the big story that we want to talk about is this really massive divergence between the broad market indexes like the S&P 500 and areas like the Dow Transports, which typically show signs of a healthy economy when they're doing well. But right now, it looks pretty doom and gloom, if you ask me, right, Joe?
Yeah, well, heading into the week, Brian, we got a lot on tap, and the market's looking for some volatility this week. We got two major events this week, and we're looking at a 1.25% implied move on this news. So we're buckling up here. There could be a big move on the CPI. Certainly, it's priced in. And obviously, you got the FOMC coming on its heels right after that.
Yeah, and so certainly when you have the CPI number this week, you have the FOMC interest rate decision, there would be some level of expectations of having some volatility. So to see a 1.25% move that the market's predicting, to me, is not that unusual. And when we've gotten some of these numbers, the market has moved big. And in fact, option prices have almost underpriced that type of move.
Yeah, so lately we've been talking about what could be a risk for the market. One of the things we brought up is oil shock. Last week was great news for oil. It came down in a nice way, Brian. It's great for the economy. It's great for the inflation expectations. I don't expect to see that on this week's CPI. Maybe it'll show up next month in the June reading. Oil can stay down here, but overall, this is good news potentially for the economy if oil stays down here.
Yeah, and we also had the jobs report last Monday, which kind of gave some indication unemployment ticked higher, but job payroll numbers increased. So it was a little bit of a mixed report, if you ask me, on where the Fed could take things in terms of interest rates. So it should be really interesting to see how the market digests this week. And we'll get more about this on the big story as we talk about volatility, as we talk about interest rate movement and how that's going to affect things, because I think there's some interesting statistics, like I mentioned earlier, between the S&P and the Dow Transports that you really want to start watching.
Well, let's take a look at the volatility, Brian. This is, of course, what we do every week. If you like this, feel free to tune in every week. We'll be looking at this volatility, we're looking at this term structure, we're looking at the skew. It's how we trade, and it's crucial to our positioning. But right now, ahead of the CPI number, we're actually seeing the VIX cash very close to where the front month is, but yet the second month is at a steep premium to where the front month is. What all things considered, the cash to the second month is about average. So, Brian, what do you make from that?
Well, I think that, the VIX being bid up this week is not unusual. Joe, you mentioned about the 1.25% move that option traders are expecting this week. Some of that then trickled down effect into the VIX calculation and the price of S&P option premium. So to see that VIX cash sit here where the VIX future is, probably about normal to see. What I think is actually kind of confusing and interesting is how high the July VIX future is relative to where VIX is at. Because before, we've seen that when that back month starts to get bid up a little bit too high, it's almost like the institutional traders know some volatility event is coming, and maybe that comes in July or August, right?
Yeah, well, I think, yes, the second month is bid up to a big premium from the front month, but it's about normal from where the cash is. So I think this is just telling me they're pricing in a move on the CPI number. After that CP9 number, vol is going to come back down, and it'll be a normal curve. You're going to get a normal front to second skew steepness. So I think we're just expecting a move on after the CPI, and then not a lot of volatility heading into the summer months is kind of what I'm reading out of it.
Yeah, that could be the case. So, I mean, what do you see like on the skew? Maybe puts and calls, we should look at that here next to see if there's sort of any indication whether there's some sort of fear building in the market, or actually there's a feel-good feeling that that the market can move higher. And when I look at this skew factor, it keeps making lower highs, right, Joe? And it seems like every time we get a volatility spike and people really get worried and want to buy put protection, all of a sudden the call buyers come back. Skew flattens out and the stock market rallies. And I think we've seen that time and again. We've seen this just recently, right?
Yeah, I mean, we saw that all last year. We're seeing it again this year. Right now, for me, we're a little bit in no man's land. Could go either way. We could get volatility plummeting after the number. We could see it kind of racing higher, looking for a little bit of a fear reinserted into the market. So we're right in the middle, not getting a huge clue from this skew. We like to look at this on the extremes when the calls are extremely bid. In other words, this skew is very low down here. That's a contrarian signal for us. Sometimes, Brian, we like to get long volatility there. When the puts are extremely bid, opposite's true. We're looking to get short volatility at this area. We're kind of in the middle here. That's not really giving us a huge clue right now. As always, we're on our toes. We're prepared either way.
Yeah, and we sold the strangle actually last week for clients when we saw calls start to get bid up and the skew come down. To us, that was an indication that maybe the volatility, was going to subside a little bit temporarily. So we sold the strangle. That's been a winner. I'll probably look to maybe take that off, I think, before the CPI number, Fed number, because I don't want to get caught either way if there's a big move out of what the Fed talks about.
Yeah, and broadly though, Brian, this is another thing we've been looking at all year long. Our position has not changed. And we talked about oil. We've talked about a lot of things that could move the market in a negative way, some things that we're watching very closely. But the trend has been our friend, Brian. The trend has been fantastic for bulls. Obviously, a few names are leading the market, but it doesn't really matter. The stock market's going higher. We broke out of this first trend channel, had a really nice move higher, and it's just been a fantastic continuation of this trend. And there's no reason for us to adjust our positioning in the market until this trend changes. There's a lot of things we're watching. There's a lot of things we're cautious about, but this trend has been a big winner for us.
Yeah, and I think in our rational equity armor strategy, our program there, I mean, me personally, I feel like this era fits that well, because when I'm looking at things and I want to figure out what investment assets I'm going to be in, I think stocks have had the momentum higher, like you see in that trend channel, but the VIX and volatility is remaining relatively low. So I can own insurance, I can own a hedge for relatively cheap at this point in the market structure. And so I think the market structure plays out really well to own stocks, own some sort of hedge protection if I'm a more conservative type investor and I don't want to go all in the market. I think right now it kind of sets up well. Now, like Joe, you talked about that skew, maybe not down to the 2 level where you want to, push in on a hedge just yet, but we're kind of right there where it seems to be, an area where you almost can get a hedge pay off for you and give you decent protection. And if you're wrong about the hedge, then certainly this trend that you just saw in the S&P probably continues higher.
Yeah, and there's no question. Also, there's been certain sectors which we favored too. The AI sectors, the chip sectors have just been fantastic, leading the way. I think this is going to bring us into our big story, Brian. That's something I want to just bring out there, just be aware of, focus in on. Not necessarily it's a sign of doom and gloom imminently, but there is an issue right now, and there is a divergence with the Dow transports, Brian. What exactly could this mean? Well, of course, when you think about it, the transports move goods, right? So when this is diverging, you're having an economic slowdown. The activity is slowing down. You talked about that jobs report. The unemployment rate is reaching higher. Yes, the headline was great. Maybe it was people getting second jobs. Maybe people were adding to the workforce because their excess savings from the COVID era has run out. So certainly this could be a sign of some slowdown. When you get a slowdown, shipping slows down. When you get the shipping slowing down, the transport stocks fall. And of course, this is just a leading indicator to everything else. So that's why I'm watching it. And that's something I just want us to focus in on. And here's what the chart looks like right now, Brian. We're getting kind of a big divergence here. And I know some of this could just be the tech stocks leading. And maybe if you look at a lot of sectors, you'll see this divergence from the market that don't include the semiconductors. But if you go back in time, you look at 2007, guess what? You got this divergence. You got this, the transport started to lag as the markets raced to all-time high. Go back to 2000, even a starker example. You got a big divergence. The market was at all-time highs, and the transports faltered before the peak.
Yeah, I mean, I would say one thing, though, is we did look, Joe, at like 1994, like the middle, basically the start of a new technology revolution, which was the internet at the time. And we did see the S&P sort of hang in there and move higher as the transport of faltered and lagged the rest of the market. And to me, that was a little bit of a rotation into that tech sector. So could this be the same thing in 2024? All of a sudden, people just want to have a piece of that artificial intelligence, that new growth technology that's part of the market. And, the NVIDIAs of the world, Microsoft, Amazon, Meta, all these guys are leading, Alphabet leading the charge higher in the rest of this broader stock market index. And the Dow transports just aren't participating in it. And then the Dow transports play catch up later on. That could be the case. But I will say there is a stark change that occurred to start this year. All of a sudden, a massive switch. It's definitely a warning sign that I'm looking at as maybe this is why people are calling for rate cuts from the Fed, because maybe other areas of the market are just not able to participate and not see the profitability that some of these growth sector names have rallied over 30% this year. So many names like that.
Yeah, and so we know AI has led this rally. We know NVIDIA, has led the semiconductors, and the semiconductors are the lion's share of this rally. Now, for this, maybe it's the case that transports will just catch up, because I kind of think AI is different from the .com. The .com was more software, more computing. I think the AI is going to reach so many places, even including transports. When you think of automated trucks with AI drivers, you got trains could be powered by AI, shipping, cargo, unloading and loading. Just think about the logistics that can be enhanced, or the productivity that could be improved by AI. So I think if that's the case, you'll see the transports catch up. However, if what's really happening is the economy slowing down, I think the divergence will be the opposite way, and the market catching up to the transports.
Yeah, and I mean, although you do see this sort of warning sign coming out of the transports, I think it still comes back. And Joe, we've talked about this on previous shows, and we got the unemployment report on Friday, right? I still think it comes back to, is the unemployment rate ticking up? Are people's credits expanding such that they're feeling the pinch? And if those two things happen, now you look at the Dow transports lagging as well. Those three things could all now add together into sort of a catastrophe kind of situation for the stock market. But I think unemployment rate still sitting at 4%, under that area. If it stops trending higher and we still get GDP numbers, I think that will be the biggest thing is, we're coming to the end of the second quarter. We're going to get the GDP number at the end of July. Maybe the VIX futures in July and August are bid up because they're worried about what this GDP number is. I think that's going to be the next biggest thing to really watch forward to, is if this divergence is simply a warning sign, or the transports will play catch up later. The economy needs to still be chugging along, whether you like it or not.
Yeah, GDP is going to be big in July. Maybe we'll be a little closer to the election. There might be some volatility spilling in from that. But yes, this jobs number, back to the jobs number, Brian, it was very interesting. It was just kind of all over the place. Some people thinking that the economy is really strong are going to point to the headline number and say, look at this. But the unemployment rate is ticking higher. So I think people saying, hey, things are softening are going to point to that. I think there was something for everybody. For me, it's kind of this the case. We're at this point in the cycle where the growth decelerates. We're kind of in an okay economy, but we're not slowing down yet. But that's just kind of how it works. Before it slows down, it has to kind of flatten out. I think we're at the flat spot. The CPI is crucial because the Fed would love to cut rates to make it so we don't go negative in the GDP. But if the inflation is hotter than expected, they might not be able to do that, and we might be forced to crush growth a little bit more than we already have. But all that said, Brian, back to just our trend, which we've been following so long. This divergence that we're talking about, it might happen. It might not happen. There's no telling when the divergence will happen. Maybe it could happen a year from now. Maybe it can start today, but until this trend changes, I don't think it's going to change our philosophy at all.
Yeah, I think these two trend channels are kind of lockstep, great indicator of where the market's going. And sort of we break this green uptrend, now you got to look at, is it going to go back into the red? And then if it breaks back into the red, is it going to go down to the lower part of the red channel, right? So these are great sort of like stop limits to have on the market if you're sort of just a momentum trader.
Absolutely. And one thing I think will be key to this trend remaining in place will be our stock of the week. Brian, Our stock of the week, we led the gains. I think if the market is going to fall, you're going to see it with NVIDIA. And if NVIDIA does have a big correction, the market's not going to be able to avoid one. itself. And of course, I'm talking about NVIDIA. Now, that a 10-for-1 split, that means, what was a $1,200 stock last week is now $120 stock now. What a bargain, Brian, for that stock right now. But it's out there. It's got new products came out last week. It's got this Blackwell platform. Their existing products have just had extraordinary demand. They've just been out there crushing it on everything. And just looking at this implied volatility, it's at 51 right now, which is just absolutely sky high. And just want to look at this chart. Sorry, having fun with the graphics here. I just want to look at this chart here. This stock had this head and shoulders pattern here in April, where we had a peak at, now is 95. It was 950 before the split, and it went down almost 20% to 750. So that this distance was about $200 or $20, would have given us a price target right here to 115. Okay, so I think it raced past this 115 spot, Brian. It reached that price target, and I think a lot of that was just because people were buying it for this reverse or this split. It really doesn't add any value to the stock, but it did have a great earnings. It does make sense for it to be right here, but I think it's due for some consolidation. I think it'll remain above this 115 level. This previous area of resistance will turn into support, but I think we'd have to have a little bit of sideways action before we can have this next leg higher. So I'm going to be taking that, Brian, with that super high implied volatility. And just looking at this week, Brian, I'm going to be doing an iron condor. I'm going to be selling a put spread and selling a call spread, $5 down, $5 up each way, selling the 117, 112 put spread, 127, 132 call spread. I'm going to collect $1.30 to do that, which will give me these break evens down there, 1570 and 128.30. That's kind of a wide range for me, and I'm going to be collecting $1.30, over 1% for 4 days of holding this trade.
Yeah, this is really kind of almost like a fixed income trade, but it's got a little bit of risk and volatility to it because you're trying to collect premium, which if you look at the annualized rate of return on this, right, this is 1% in a week's worth of time. Multiply that by 52, that's 52% annually you could potentially make on this. So obviously huge premium and income that you can collect, but there's some risk to this, right? Because up, call it 4 or 5% to the upside, that 128.30 level is break even. So above there, you'd start losing money all the way up to 132, right? Which could be a decent loss in a short amount of time. And then on the downside, that break even 115, I think that's enough room. That's about 6% or so to the downside where there's enough of a cushion that probably doesn't hit. But I mean, the amount of premium in this stock right now, the stock is split. That means there's more shares in the marketplace, which typically as a former market maker, when we see that happen, we usually see volatility start to compress a little bit because now market makers can tighten up the market because there's more shares being traded back and forth. And so the level of volatility typically that hits a stock declines. That's at least what I have found. So to me, this seems like a good trade to try and just make an educated bet, which is a very high yield rate of return on an annualized basis for a short amount of time. And hopefully the CPI number and the Fed number doesn't move NVIDIA too much outside of that range such that I make the money. So this is really, it's a fixed income trade, but it's almost like a casino kind of educated bet where you feel like, at least I feel like I have edge in the marketplace to sell that option premium.
Yeah, absolutely. I feel like 115 is an area where I'd be happy to be buying the stock back because that was an area that was previous resistance comes support. And I think it needs that consolidation. A great point on the reverse split. There's more liquidity in the market. It kind of can do a dampening, throwing a wet towel onto the volatility. And volatility is super high just for a 1 week hold. 51 is very high now. Heading into this week, you all wanted to buy that volatility on the call side because it was just racing higher. I think we're due for a pause. I could be wrong, of course, and I know exactly what I'm laying out on this trade if I am wrong, which I'm totally comfortable with.
Yeah, and also note that one option contract is equal to 100 shares, so you're collecting basically 130 bucks on this, right? So just watch that, manage it. If I was long stock, this might be a decent overlay to overlay my long stock position, because then I'm maybe called away to the upside. I don't really lose just by naked shorting this condor. And on the downside, I'm okay owning a little bit more NVIDIA down at that 115, because I'll find a way to sort of get out of that trade, hopefully for break even. If it were to get hit down there, I'd kind of look to work around that.
Yeah, and again, had great earnings. They announced this split, raced through this resistance. I think the splits kind of happened. I don't know what the catalyst is for the next leg higher. Of course, it can happen. Of course, it's potentially out there. But I think just for me, I'm happy to just kind of lay it out here and play it. You said, hey, 50% return annualized is fantastic. I know NVIDIA holders are saying, hey, I got a 400% gain over the year. Like, what are you talking about? 50% is nothing. But for me, this would be plenty.
Yeah. Well, I don't know. These are some great trades, Joe. We really hit the number on a lot of these trades. Make sure you continue to follow us on YouTube at Equity Armor on the YouTube channel. Follow us here on the Tradier Hub. This has been a great show. Trading Zone, sponsored by the MIAX. We thank you, and continue to follow us. And we have some exciting things coming up, where we're going to give you some nice giveaways that will, in addition to our show. So continue to follow us there. I think we'll have some nice offerings as well. And also check out Equity Armor Investments, their webpage, and some of the trading programs to sort of follow in with Joe and my personal opinions, and what we talk about the market here. You'll be able to follow us along more easily there. And so this has been a great show. Remember to tune in every Monday, 1 p.m. Eastern. We got started a little bit late to Joe this week, but we'll be on time next week and the weeks coming forward. This has been a great show. Any other thoughts before we say goodbye?
Yeah, follow us on Twitter for those contests. It'll be fun to do. Can't wait to just talk to you guys, hear what you're thinking, give us some ideas on what you like and what you don't like.
All right, we'll see you next week, 1 p.m. Eastern every Monday. Follow us here at the Trading Zone. We'll see you next week.
Have a good one.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.